Welcome to the Deep Dive, where we dissect the numbers and strategies behind the headlines.
Glad to be here.
Today, we're plunging into the Q2 2025 earnings call from Dave & Buster's Entertainment, Inc., ticker symbol PlayY. That call happened on September 15th.
And it was definitely a quarter that presented some real challenges.
Oh, yeah. It delivered a genuine gut punch to investors. You saw the stock reaction.
Absolutely. The market reaction was pretty swift, reflecting that disappointment.
But beneath that, there's a new CEO charting a course to, well, try and revive this entertainment giant.
Right. A turnaround story in the making, potentially.
So our mission today is to unpack the numbers, dissect this new strategic vision, and figure out if it's a genuine turnaround or maybe just a fresh coat of paint.
Yeah, is it fixing the core issues? That's the key question. This call really highlighted the tricky spot a lot of consumer discretionary businesses are in right now.
Mm-hmm.
And that sharp market reaction, it wasn't just about the specific Q2 numbers, it's about a deeper skepticism, I think.
Mm-hmm.
Investors really want proof, especially for turnarounds.
They want to see it happen, not just hear about it.
Mm-hmm.
Sets a high bar for the new leadership.
Definitely.
Okay, so let's jump straight into the core numbers that sparked that investor disappointment from Q2.
Let's do it.
Dave & Buster's reported a GAAP EPS that's generally accepted accounting principles earnings per share of 32 cents.
Okay.
And an adjusted EPS, which often excludes one-time items for a clearer view, of 32 cents.
Right. And that $1.40 is adjusted. That was the big story.
Because it significantly missed the consensus estimate, which was around 88 cents.
Yeah, a huge miss. That wasn't just substantial. It was, a 54.6% surprise to the downside? Ouch.
Ouch indeed. And revenue for the quarter, $557.4 million. Basically flat year over year, and also came in slightly below what analysts expected.
So you pair that massive EPS miss with flat revenue and a 3.0% decline in comparable store sales year over year.
Right.
It signals something more than just one tough quarter. It starts to suggest maybe an erosion of pricing power or maybe some real issues with cost control.
Things the market really doesn't like right now.
Especially not in consumer discretionary spending.
And while adjusted EBITDA stood at $129.8 million, that's a 23% margin. It's worth looking at the leverage picture, too.
Definitely.
They generated $34 million in operating cash flow, and they maintained total liquidity of $443.3 million.
Mm-hmm.
Sounds okay,
but that net total leverage ratio is currently sitting at 3.2 times.
Yeah.
And that 3.2x leverage, that's a critical number to watch. For a company in this sector, entertainment and leisure, that's a level that, it needs careful management.
Especially with declining comps.
Exactly. It limits your financial flexibility. It makes it harder to fund growth yourself or take on more debt without adding, more risk.
On a slightly brighter note for capital, though, they did generate about $77 million in cash through sale-leaseback deals and build-to-suit commitments.
Okay, so they are actively using their real estate assets. That shows some effective management on that front, at least. Monetizing real estate.
Right. And growth-wise, despite these pressures, they did open 3 new Dave & Buster's stores in Q2.
Still opening stores.
Yeah, plus another D&B and 2 main event locations opened early in Q3. And they also expanded internationally, a second franchise spot in India.
Okay, so the pipeline isn't completely stalled. New stores, international expansion, those are typically good long-term signs.
Right.
But the immediate financial performance from the existing stores, that's telling a story of, significant short-term headwinds. And as management themselves admitted, some internal execution challenges that need fixing, like yesterday.
Okay, so let's leave the raw numbers there for a second, dive into the strategic side, the new leadership.
Right, the new CEO, Tarun Lal.
He officially took over July 14th.
Mm-hmm.
Comes with over 30 years from Yum Brands, including leadership at KFC.
A lot of relevant experience there, high-volume consumer brands.
And what stood out to me was his initial approach. Very hands-on, emphasizing a guest-first culture.
Mm-hmm.
He even mentioned training in stores alongside a manager named Garrett, just to really get the ground-level experience.
That's smart, especially coming in new. It signals he's not just looking at spreadsheets, he's engaging with the core operation.
And his initial take largely aligns with the plan from the former interim CEO, Kevin Sheehan, focusing on that category of one positioning and simplifying the value message.
So it suggests continuity in the big picture strategy, but maybe with a renewed, perhaps more disciplined focus on actually getting it done. Execution.
Yeah, that seems to be the theme.
The big question for me, though, is whether these execution missteps they talked about are really just surface level or if they point to deeper, maybe systemic issues.
Well, he certainly didn't pull any punches identifying those past missteps. Management listed several areas where they felt the company fell short.
Okay.
Looking at this list, marketing, food and beverage, operations, games, remodels, CapEx. Which of these do you think had the most crippling impact on Q2?
That's a great question. They all probably contributed, right? But if I had to pick the most immediate crippling impacts, I'd probably point to two: marketing and games.
Okay, why those?
Well, moving away from TV ads and having this sort of unfocused promotional strategy that directly confused customers, it impacts traffic.
Yeah.
In this competitive entertainment space, you need clear, consistent messaging. Confusing your audience, that's a recipe for declining sales.
Makes sense.
And games, I mean, an 80% reduction in new game introductions, that's huge.
Wow, 80%?
Yeah, and couple that with complex pricing. The midway, the games, that's the heart of Dave & Buster's, right? If it's not fresh, not exciting, not easy to play, guests just won't stay as long or spend as much.
It's like a movie theater not showing new movies.
Exactly. You lose your core draw.
Okay, so marketing and games hitting the core experience. Beyond that, they also flagged issues with food and beverage, leaning too heavily on appetizers and shareables while actually cutting some high-revenue menu items.
Doesn't sound ideal.
Operationally, they admitted rapid rollouts led to communication breakdowns, less focus on training.
The classic moving too fast problem.
And then overspending on underperforming remodel prototypes that didn't have enough marketing support, plus just poor capital expenditure discipline overall.
Yeah, those F&B and operational issues, they suggest a disconnect, right, between the corporate strategy and what's actually happening in the stores.
Definitely.
Simplifying the menu, proper training, that's foundational for a good, consistent guest experience. Crucial for repeat business in this industry.
And the remodels and CapEx.
That's not just wasted money. It means they miss chances to invest in projects with better returns or, strengthen their balance sheet. It just compounds the financial challenges.
So management calls these fixable execution issues.
Right, fixable. But fixing them requires a comprehensive, focused, and frankly, a flawless effort. No room for error now.
So given this pretty candid admission of past problems, what's the path forward? They outlined a strategic reset, some immediate catalysts.
Okay, the plan.
In marketing, they're bringing back TV advertising, sharpening promotions fewer, more focused offers to make the value message clearer. Importantly, though, no significant increase in marketing spend planned right now.
That's interesting. It suggests they think the problem wasn't the amount of spend, but how effective it was.
Right.
Simplifying the message, using TV again, that could cut through the noise, address that customer confusion, and hopefully drive some traffic back.
On food and beverage, a back-to-basics menu, they're reintroducing fan favorites. That's set for a nationwide launch in October.
Back to basics. Could work. People like what they know.
And the Eat and Play combo, the EPC, it's actually shown improved attach rates already.
Yeah.
About 8-10% opt-in, which they said is higher than historical levels.
Oh, that is encouraging.
And special events revenue is a genuine bright spot, up nearly 10% year over year for the D&B brand.
Okay, so that's genuinely good news. The back to basics menu, if it hits right, could drive check growth without just hiking prices.
Yeah.
And the success with the EPC and special events, it shows that when value and unique experiences are communicated well and executed properly, people do respond, even now.
Right, even in this environment.
This is where they can really lean into being that category of one they talk about.
Operationally, renewed focus on training, better communication between corporate and the field teams, all aimed at enhancing guest experience.
Makes sense. Blocking and tackling.
And for games, a commitment to introducing 10 or more new marketable games each year.
Okay, addressing that 80% drop.
Focusing on exclusive titles, maybe some culturally relevant IP, and game pricing, simplified. Essentially one tier now.
Easier for the customer.
Optimized rate card entry points, game level pricing, all designed to increase how long guests stay and the perceived value. Plus some strategic win pricing to manage margins.
Reinvigorating the game floor with new stuff, exclusive stuff, and simplifying the pricing that directly tackles those past mistakes. It's absolutely crucial.
Trying to improve that value perception.
Exactly. And increasing dwell time. That's a key metric. The longer people stay, the more they usually spend not just on games, but food, drinks too. It's fundamental.
They also have a revised remodel program. New prototype, marketing support, set to debut in the coming weeks.
Okay. Learning from the past mistakes there, hopefully.
And get this, existing remodeled stores have actually outperformed the non-remodeled ones by 700 basis points.
Wow, 700 basis points. That's significant.
A huge difference.
Yeah.
But here's the catch. Management noted that Q3 comparable store sales trends, quarter to date, were consistent with where they were exiting Q2.
Ah, so still soft.
Yeah, indicating continued softness. So how do we square that? Great remodel performance, but ongoing overall softness.
That's the tension, isn't it? The 700 basis point outperformance, that clearly validates the remodel concept when it's done right. It suggests the physical improvements plus better marketing do work.
But it's not enough yet.
But the Q3 commentary is that reality check. It tells us these promising things haven't yet translated into an immediate broad acceleration in comps across the board. Yeah. Turnarounds take time. The benefits of new strategies, they often don't show up in the numbers overnight, especially when you're fighting broader economic headwinds.
So to try and boost things in the meantime, they launched a fall season pass, unlimited daily gameplay, discounts.
Okay, driving frequency.
With a winter pass planned for Q4, football watch offerings, a 2-minute drill midway challenge.
Engaging content.
And that human crane game. They're expanding that.
These seasonal passes, unique challenges. They're smart tactics. Drive frequency, perceived value, especially for their core crowd. It taps into that idea of experiences, social connections. That's a brand strength for them. It's a way to try and pull people in while the bigger strategy changes take root.
Okay, let's talk capital allocation development. Dave & Buster's expects to open 11 new stores total in fiscal 2025.
Still expanding the footprint.
And they're citing strong year-one cash-on-cash returns, like 40%. On those new units.
40% is a solid return if they can hit it consistently.
International expansion is also seen as a highly efficient growth driver. 5 more international openings expected in the next 6 months.
Franchising mostly, I assume.
Yeah, and agreements for over 35 additional stores in the coming years.
That commitment to new units, especially international franchising, which is less capital intensive, it shows they still have confidence in the underlying business model's profitability, despite the current issues.
Right.
And that real estate monetization, the $77 million in Q2, that's the lever they keep pulling to fund this growth and manage that 3.2x leverage we talked about.
Okay, now here's where it gets really interesting, maybe a bit provocative.
Oh, go on.
CEO Tarun Lal stated his compensation package is directly tied to achieving $675 million in annual adjusted EBITDA.
Directly tied. Okay.
He confirmed this as the new IA target. That's a notable revision from a previously discussed $1 billion target.
$1 billion. Wow. Okay. So $675 million is the new number.
Yeah. And he clarified he wasn't aware of a specific timeline for that older $1 billion figure. So what's your take on recalibrating the target like that and tying CEO pay directly to it?
This revised target, the $675 million, that's absolutely crucial information for anyone following this stock.
Why crucial?
Well, first, it's a big step down from prior, maybe overly ambitious goals. Tying the CEO's pay directly to this number, which he calls highly achievable, it suggests a much more realistic, focused goal for the near term.
Pragmatic, maybe?
Exactly. A pragmatic recalibration. Acknowledges the current reality, sets a very clear internal benchmark. But the underlying question for you, for investors, is whether this achievable target still offers enough upside potential for the stock to really re-rate significantly.
Right. Or does it just lower the bar?
Or does it just reset expectations to a more pessimistic baseline, effectively lowering what success even looks like? It's a double-edged sword. Highly incentivizing for the CEO, yes, but also potentially signaling a more tempered outlook for the company's ultimate potential compared to, say, that $1 billion idea.
That's a really important distinction to make. Okay, let's shift focus now to the broader investor context.
Right, how the market's seeing all this.
The immediate reaction to Q2, as we said, sharp sell-off. Fragile investor sentiment seems like an understatement.
Yeah, shares fell, 15% after hours, nearly 17% by the next morning.
Something like that. Sell-side analysts, Piper Sandler included, trimmed their price targets.
That swift downturn clearly shows investors are zeroed in on that big EPS miss, the continued soft comps, and worries about margin compression. Even with management saying these are fixable execution issues, the market is demanding results. Tangible results, not just promises. It's a classic show me situation. Words aren't enough right now.
And the whole entertainment sector is facing headwinds, right? Traffic softness, people being more sensitive about value.
Definitely. Management acknowledged consumers are looking for value for their money.
So their strategy? Simplifying value messages, enhancing the brand. It's aimed right at that.
It has to be. It's a consistent theme across consumer discretionary right now. Dave & Buster's has to prove their specific strategies, clear value, unique games can effectively set them apart when consumer spending is tight.
Yeah.
If they can't give consumers a compelling reason to choose them over other options, even with better value messaging, the challenges are just going to persist.
Management, though, they do believe the stock is materially undervalued.
Yeah.
They see significant upside potential based on very achievable financial results in the near term.
They see it as fixable execution, not fundamental strategic flaws.
Right. But the market, like you said, is waiting for that proof of life.
Exactly. Management's confidence is clear, it's palpable, but until those comp store sales numbers and the margin performance actually turn positive and stay positive consistently, investor sentiment is going to remain cautious, no doubt about it.
The market needs to see the turnaround actually happen in the financials.
Precisely.
This disconnect, though. Management convinced it's undervalued, market skeptical. It often sparks some interesting possibilities.
I think I know where you're going with this.
Which brings us perfectly to our This Is Not Financial Advice segment,
My favorite part.
where we throw out an outrageous but plausible trade idea. Strictly for educational and entertainment purposes, of course.
Of course, where we get to imagine the wild possibilities using everything we've just discussed.
So you've got the Q2 miss, the new CEO, that clear, incentivized, lower EBITDA target of $675 million presented as highly achievable. It creates this fascinating dynamic.
It really does. That explicit link between the CEO's pay and that specific target, it's a powerful incentive for him to focus intensely on execution, on cost management, puts a clear finish line for his initial run.
Okay, so here's our outrageous but plausible trade idea for today. Consider a leveraged private equity buyout.
The LBO angle. Makes sense.
With the stock taking a hit, management calling it materially undervalued, highlighting fixable execution. A savvy PE firm could see this as a classic opportunity.
Right. Buy low, fix it up, sell high. The PE playbook.
They could leverage the company's significant real estate assets for more monetization. Remember that $77 million they just generated.
Use the property as collateral.
Exactly. Then take on more debt, pushing that 3.2x leverage even higher to acquire Dave & Buster's outright.
Take it private.
Take it private. The goal. Execute Tarun Lal's focused back-to-basics turnaround plan, but away from the quarter-to-quarter scrutiny of the public markets.
Let him work without the constant pressure.
Hit that $675 million adjusted EBITDA target he's incentivized to reach.
Yeah.
And then either re-IPO the revitalized company or sell it to another buyer at a significant premium in, say, 3 to 5 years.
It's definitely a compelling story for a PE firm that believes in the core asset value and the new CEO's ability to execute. Taking it private removes that public market noise.
The underlying real estate value, that unique category of one positioning, plus a highly motivated CEO.
Yeah.
It could look attractive to a firm willing to take on the operational work and the extra debt.
It's audacious, pushing leverage higher when it's already at 3.2x, but certainly plausible given everything we've discussed. It fits the PE model.
Okay, so to recap our deep dive today, Dave & Buster's faced a definitely challenging Q2. That was reflected in the earnings miss and the market's pretty sharp reaction.
But new CEO Tarun Lal has laid out a clear vision, a guest-first turnaround directly addressing those past execution missteps. Focused initiatives in marketing, food, games, operations.
The path forward includes that nationwide menu relaunch, the simplified game pricing, a revamped remodel program, continued new store growth.
And it's all underpinned by that more modest but apparently achievable $675 million adjusted EBITDA target, which is directly tied to the CEO's compensation, a key detail.
The market, though, is clearly waiting for these catalysts to actually translate into better traffic, better margins, tangible improvement.
Needs that proof of life.
As always, this discussion is purely for informational purposes. It is absolutely not financial advice. We encourage you always do your own research, consider all perspectives. As we wrap up, what stands out to you as the single most critical element for Dave & Buster's to deliver that proof of life the market's demanding?
The single most critical element. For me, it really boils down to sustained, positive, comparable store sales growth.
The comps.
Yeah, the comps, all these operational changes, the marketing shifts, the new games, Ultimately, they need to funnel into that metric. That's what demonstrates genuine, sustained consumer engagement and proves the turnaround is real. It's the ultimate report card.
A tough metric, but clear.
Yeah.
That's a crucial takeaway. Thanks for joining us for this deep dive.
My pleasure. Lots to watch with this one.